Imagine waking up tomorrow knowing your housing, food, and healthcare are already paid for. No alarm clock, no daily commute, and no boss. Just passive investments covering your expenses while you sleep. I am going to show you a step-by-step mathematical roadmap to make that a reality, replacing your standard salary with passive income from commercial real estate. Grab a pen, a piece of paper, and a calculator. You are going to map out your exact numbers as we move through this process. Reaching complete financial independence is a solvable equation based on the predictable yields of income-producing property. Most Americans live in a state of extreme financial vulnerability, relying entirely on one single employer for their survival. Think of this as the single paycheck trap. Your entire financial life is a massive weight balancing on one very fragile pillar. The moment that paycheck stops, the support vanishes, and everything crashes down at once. To escape this trap, we need to define your freedom number. This is the specific monthly dollar amount your investments must generate to safely cover your living expenses. Look at your monthly take-home pay. For our working example, we will set a target of $4,000 a month. Writing down that exact numerical target immediately turns the vague psychological desire of getting rich into a concrete, achievable milestone. When you think of commercial real estate, you probably picture needing millions of dollars upfront and dealing with constant property management headaches. We are going to bypass that completely using a specialized financial vehicle called a real estate investment trust, or REIT. A REIT pools money from investors to purchase income-producing properties. It creates a direct bridge connecting your smartphone app right to high-value skyscrapers. By law, these trusts must distribute the majority of the rent collected directly back to shareholders as dividends. Collecting these dividends requires absolutely zero labor from you. No tenants to text back, no broken pipes to fix, and no property managers to oversee. REITs effectively strip away the active labor of being a landlord, leaving you with a purely passive income stream. Now let's run the math to see exactly how we scale those dividends up to match our $4,000 freedom number. This mock-up of a financial brokerage application shows you where to look. By checking a REIT's ticker symbol, you can find its historical dividend yield percentage right here, alongside this graph tracking its payout stability. You might be tempted to chase the highest percentage you can find, but massive yields are often a warning sign of financial distress. You want stable, long-term consistency over an immediate, unsustainable spike. To find your target portfolio size, divide your annual income goal by the dividend yield. For example, if you aim for $48,000 a year at a 5% yield, you need a total portfolio of $960,000. You accelerate the journey by automatically reinvesting initial payouts to buy more shares. Every dividend loops back to increase your share count. This compounding loop drives your monthly payout exponentially higher until it crosses that $4,000 ceiling. Building a $4,000 monthly income relies on the consistent accumulation of these cash-flowing assets over several years. Today, we defined your freedom number, mapped out the danger of the single paycheck trap, and identified REITs as the specific tool to break it. Instead of relying entirely on a fragile job for survival, you now possess a mathematically sound escape plan. Your next step is immediate. Open your brokerage app today and review the dividend history of just one commercial REIT. That foundation will prepare you for the next critical step. Hit subscribe right now, because in our next video, I will show you the exact criteria you need to select the safest, most reliable assets on the market. Most people look at the commercial real estate market and assume it is an exclusive sector reserved strictly for the ultra-wealthy and institutional giants. But the landscape shifted after the 2021 market peak, which was followed by a series of significant price corrections. High market uncertainty forced a lot of big, over-leveraged buyers out, causing institutional volume to drop steeply as they prioritized their existing debt over new acquisitions. This retreat by the big players removes the primary source of aggressive bidding wars, allowing smaller investors to negotiate on properties that were recently priced out of reach. Forecast data from CBRE suggests this period of low competition is meeting a major market rebound heading into 2026. This chart shows that investment activity is projected to jump 16%, pushing the total to $562 billion, nearly matching pre-pandemic levels. This 2026 window offers a rare combination: a rapidly recovering $562 billion market that is currently missing the dominant institutional giants that usually control it. Bypassing the massive capital requirements of a direct purchase starts with pooled capital. REITs and modern crowdfunding platforms allow individuals to buy into commercial portfolios with as little as $10 to $500. REITs operate under a specific legal mandate. They must pay out at least 90% of their taxable profits to their investors as dividends. These platforms allow real estate to function as a passive financial instrument, removing the need for investors to manage physical tenants or property maintenance. Syndications offer a mid-level step for those with more capital who still want to avoid daily management. In this structure, a professional operator assumes all the logistical labor, from finding the deal to managing the property day to day. You enter the deal as a limited partner, typically providing a capital contribution of $10,000 to $25,000. This allows an investor to leverage professional expertise and scale a portfolio without taking on the operational risks of a sole owner. For those pursuing direct physical ownership, the strategy involves looking past high-rise office buildings towards smaller, functional assets. Small-scale warehouses are highly viable commercial assets with simple management requirements. Local service businesses like barbershops represent standard commercial properties often found in local neighborhoods. Small medical offices provide another stable entry point, often featuring long-term, reliable tenants. Maximizing these physical investments means targeting booming secondary markets rather than oversaturated megacities. Columbus, Ohio is currently a prime example of a market with high growth and accessible commercial prices. San Antonio, Texas also demonstrates the high population and job growth typical of an ideal target market. By focusing on these smaller assets in high-growth geographies, physical commercial property can be acquired at price points similar to residential housing. Commercial real estate is accessible today through a series of specific entry points that scale with an investor's available capital. Pooled platforms, syndications, and micro-assets provide three ways to claim a stake in the market today. The economic correction has left a temporary opening for retail investors, while institutional competition remains low. Taking advantage of this window requires moving past the assumption that the market is closed and beginning the process of financial education. Which of these commercial property types fits your current financial goals?